Hi, I'm Dolph Janis at Clear Income Strategies Group. I'd like to personally thank you for taking a few minutes out of your day to learn one of the most easy topics, but most misunderstood topics out there today, and that's the difference between qualified funds and non-qualified funds. Knowing the difference between these two could potentially save you a lot on penalties and taxes going forward. I mean, no one likes paying taxes, but knowing the difference between qualified money and non-qualified money is very important when it comes to taking your money out in retirement and planning to and through retirement at the same point. So let's break these down individually first. Let's start with qualified funds. First, qualified funds is an agreement you made with the government that you can put money in there for your life until you hit the age of 72 and not have to pay taxes on that money. But it stays tax deferred during that whole time frame, which is wonderful, meaning every year all the contributions and all the interest you make, you're not having to pay taxes on this. When you withdraw this money, you do have to pay taxes on all the money, whether the gains, what you've put into, all contributions, and so forth. But the caveat is, once you hit the age of 72, it's called an RMD, Required Minimum Distribution. You have to start taking a portion of your money back out. This is the agreement you made with the government back in the day. When you hit 72, you unfortunately have to start taking money out. There's ways to avoid paying the taxes on that with QCDs. That would be in another video, or you can give us a call. We can answer that question for you. And any withdrawals you make prior to 59 and a half are subject to a 10% penalty. Unless it's for a medical condition or a hardship, generally those are the only changes that you can make to where you don't have to pay the 10% penalty, but that's where the 10% penalty would come out in withdrawals prior to 59 and a half. Example of the most common qualified money that are out there, you have the IRA, the SEP IRA, the simple IRA, the 401k, the 403b, pensions. Those are the main qualified monies out there, qualified funds. The one exception to the rule is the Roth IRA qualified money, but that will be in another video. But a Roth IRA, once held for 5 years, when you take money out of that, you don't pay taxes on the interest, you don't pay taxes on what you put in there. Again, that will be in a separate video. Please watch that one as well. Non-qualified money. This is after-tax money. Think of kind of like the money that's in your back pocket. It's money you've already paid taxes on. You only pay taxes on the gains in a non-qualified fund. Only tax-deferred accounts with a non-qualified funds are such as an annuity, where annuities are one of the few instruments out there that allow you to put non-qualified funds in there and not have to pay taxes on it every year. Like if you had a CD or a savings account, you're going to receive that 1099 every single year. Otherwise, if it's not tax deferred in an annuity or tax sheltered annuity, you will receive a 1099 every year. Typical places you'll find non-qualified funds: checking accounts, saving accounts, money market accounts, and CDs. And that there are CDs that are qualified, like qualified IRA CDs. Generally, CDs, most of them out there are non-qualified funds. And those, again, are taxed at ordinary income. So knowing the difference between qualified funds and non-qualified at the end of the day can help you prepare what your structures are going to be for tax-free money, tax-deferred money, and taxable money going into your retirement. I'm Dolph Janis. Thanks for saving a few minutes of your day to learn about this. For more of the complimentary resources we have, feel free to go to guardyoursavings.com. Take care, and I hope to teach you some more soon.